Hello friends, welcome back. Today we are discussing about financial budget, budgeted financial statement and something about budgetary control. In the previous session, if you remember, we discussed about operating budget and the financial budget. Operating budget focus on revenue, production, purchase, warehouse and business related operations. When it comes to financial budget, it focus on cash management, financial requirement, investment, budgeted financial statements. Financial budget, we know it's play a very crucial role in the overall budgeting process, because with the financial budget only we know the expected profitability of the company, expected rate of return, cash position, expected financial positions and many other financial metrics. The key financial budget include, first one is a capital expenditure budget, then the cash budget, budgeted balance sheet and budgeted statement of cash flow. Plus again budgeted income statement as well. So all this will help the management to see the expected financial position and financial result of the company beyond based on the expected based on the operating budget. So the financial budget typically which start from the operating budgets. Once you develop your operating budget, you can start developing financial budget as well. Now let's move into component of financial budget. The first one is capital expenditure budget. What is capital expenditure? Capital expenditure, or what we call as capex. It's the investment or planned investment in the long-term asset like property, building, machinery, equipment and technology system. This is the investment in assets. We know that capital budgets for the big companies include very big, huge cash commitment. So it has to be planned very well in advance and it has to be aligned with the overall budget as well. Again, the capital expenditure which will have an impact in the other financial statements as well, like your income statement, cash flow statement and balance sheet as well. The second component is cash budget. What is cash budget? Cash budget which will show the expected cash collection and cash expenditure or cash revenue, income and cash expenditure for a particular period. So which will help the management to determine whether the sufficient cash is available for a particular period, is there any financing required, whether we have excess cash, or is there any investment decision or the borrowing decision has to be happened, is there in any particular period. So the cash budget will show the expected cash inflow and expected cash outflow for a particular period. Now the budgeted balance sheet. What is budgeted balance sheet? Which will reflect your planned asset, your expected liabilities and expected shareholders equity, which will show the expected financial position of a company for a particular point of time. Then the budgeted statement of cash flow. We know that statement of cash flow is a statement which shows total cash inflow and cash outflow for a period of time. Again, which is classified or which is summarized the overall cash inflow and cash outflow into operating activities, investing activities and financing activities. So the budgeted statement of cash flow will show the expected cash inflow from operating activities, investing activities and financing activities plus expected cash outflow from these three activities. So which will help the management to plan the cash in advance and to see is there any borrowing required or is there any excess fund to make an investment. Now the next component, that is cash budget. Cash budget is one of the most critical tool, because we know that without a proper liquidity or cash, the business cannot run its operations. Cash budget sometimes referred as cash management budget, cash flow budget and working capital budget. Cash budget normally which will prepare on a monthly basis or even daily or weekly basis, because there should be sufficient cash available in the business once it is required. So to see that, the cash budget normally which is preparing for a shorter period of time, like a week or a month maximum. Again, the cash budget help the management to ensure that company can meet its obligation as they become due, while avoiding excessive idle cash balance as well. Cash balance which will help the management to avoid excess cash and the shortage of cash. So now we will move into importance of cash budget. Company can report accounting profit and still experience cash shortages. We know this one. If the company reports a revenue or a sales, automatically it will report the profitability. But when it's come to cash, it can be in a bad position as well. Suppose the customers may delay the payment, or inventory purchase may require immediate cash, or debt payment become due, or large capital expenditure may occur. So in this example, in these cases, in such cases, what can happen? The company can show still a big profit in the profit and loss account, but the cash position can have a shortage. So without a proper planning, if we have a proper cash planning, we can reduce this shortage as much as possible, and we can plan some borrowing, short-term borrowing if required. Now, a proper cash budget helps the management to anticipate the future cash shortage. If the companies put all their expected cash inflow and cash outflow in a single sheet, they can see that is there any expected cash shortage in the future, and plan financing needs. If they require any short-term financing in the future, they can plan that requirement, and it will help them to identify the surplus cash. Is there any surplus cash in the business? So they can identify the surplus cash for that particular period and plan the investment. Then improve cash utilization. If the excess cash available in the business, they can utilize that excess cash for business improvement or in the outside investment as well. Then the reduce financial risk. If we plan our cash budget in very well, which will reduce your financial risk into a certain level. Now we will look into the relationship between cash budget and other budget. We know cash budget have linked or have a relationship with multiple other budget, like the sales budget, purchase budget, labor budget. All these have a direct impact into cash budget. So first relationship is with the sales budget. So which will provide the information regarding the expected collection from the customer. If you look into sales, you can see the expected, or you can forecast the expected collection from the customer for a particular period. Then the direct material purchase budget. Based on your direct material purchase and your credit terms with the suppliers, you have to plan the cash outflow from the business. Then the direct labor budget. Based on the direct labor budget, you have to pay the payroll and other direct labor expenses. So it is a cash outflow. Then the manufacturing overhead budget. Based on the manufacturing overhead, there will be some expenses you have to consider while you are preparing the cash budget. Then the non-manufacturing budget, like your selling, administrative and other operating expenses, also have a big impact or a direct impact with your cash budget. Then the capital expenditure budget. Capital expenditure budget, which is mainly the investment in the assets. So which will have a long-term commitment or a impact with the cash budget or cash budget to see the expected cash outflow for capex. Now, we will look into the difference between cash budget and budgeted statement of cash flow. So, these both are served for different purpose. Both are seems to be same, but the cash budget and cash flow budget which is serve with the different functions. The cash budget mainly focus on expected cash receipt, expected cash disbursement, cash surplus and cash deficit. This is the focus of cash budget. But when it's come to cash flow budget, which classify overall business activities or cash flow activities into operating activities, investing activities and financing activities. The key purpose of budgeted statement of cash flow is to financial reporting and analysis, but the cash budget is mainly focused on cash management and cash planning. Now, let's move into sources of cash receipts. What are the sources normally business can expect to collect the cash? The first one is collection from customers. Once you made a credit sales, you can collect that cash from that customers once the invoices are on due. Now, the sales of asset. If the company sell any of its assets or disposal of equipment, vehicle, building or any other asset can generate cash inflow. Then the borrowing. Borrowing mean bank loan, line credit or note payable. These are some financial tool or instruments the company can borrow money to finance its cash shortage. Then the equity financing. Equity financing means the company can generate cash inflow by issuing shares or equity shares. The next source is investment income. If the company is invested in any of the investments, it can generate a revenue as a return for that investment or investment return, which is a cash receipt for the company. Now, let's look into some cash disbursement, expected cash disbursement for a company. The first one is direct material purchase. If the company has made a purchase, there will be a cash disbursement related to the purchase, whether it is even if it is a credit supplier, still you have to pay the suppliers once the credit is due. Then the payroll cost, your employee salary cost or HR cost is one of the key cash disbursement. So you have to consider the payment of wage, salary and employee benefits into your cash disbursement plan. Then manufacturing overhead. That means all the indirect product cost required cash expenditure. Then the selling and administration expenditure, like non-manufacturing expenditure related to business operations, like your selling and administration expenses. Then the capital expenditure, which include your purchase of equipment, building and other long-term assets. Then the taxes. Taxes mean the income tax payment and other government obligations which have a cash outflow commitment. Then the debt repayment. The principal and interest payment on your borrowings. These expected cash outflow must be carefully scheduled to ensure adequate liquidity. So these are some expected cash outflow for a business. So all this cash inflow, expected cash inflow and cash outflow has to be well scheduled to ensure the adequate liquidity and a better financial position. Now, if you find if we are expecting some cash shortage in the future, how we will manage that cash shortage? One of the purpose of cash budget is to identify the expected future shortage before it occurs. Once you identify a shortage, you have to find a way to manage that cash shortage. So the possible solution include obtaining short-term loans, arranging line of credit, delaying non-essential expenditure, again accelerating collection from the customers and raising additional equity capital. So these are some ways to find out or to gap the cash shortage. Again, a better plan and better cash budget will help the management to plan their shortage or to manage their cash shortage and to find a better way to improve the overall cash position. Now, if you find you have some excess cash for a particular period of time in your business, so what you have to do? You have to manage that excess cash in a profitable way, in a better way. Otherwise, it will remain in the business as a non-active or non-revenue generating cash. Again, it's represent a opportunity cost as well. So if the management identify some excess cash or excess cash in the business, so it has to plan the excess cash as well, like a short-term investment in the or invest in the marketable securities or some interest-bearing accounts or other low-risk investment opportunity. So if the business have expected some excess cash in the business, so it has to be properly managed and to find a way to invest that excess cash in a profitable way. Now, how to manage cash budget in the seasonal business? So the seasonal business mean some examples of seasonal business, we can say that retail businesses, tourism companies, agricultural business and holiday related industries. Seasonal business often experience period of cash inflow followed by period of low activities. So normally the seasonal business in some season which have a high cash inflow but in some period which experience low activity and low cash inflow. So the monthly cash budgeting allowing management of seasonal budget to prepare for seasonal fluctuations, again scheduling borrowing needs, managing inventory level and planning production activities. For the seasonal business, we know that the annual budget alone is not sufficient to manage its business effectively, because seasonal business required a separate concept or separate approach in the budgeting process. Now, let's move into budgeted financial statement. What is a budgeted financial statement? It is the preparation of financial statement, key financial statement like income statement, balance sheet, statement of cash flow based on the budget. We are preparing the expected income statement, balance sheet and statement of cash flow based on the budgeted figures. So the major budgets are the budgeted income statement, which include projected expected revenues, expenses and profit. Then the budgeted balance sheet, which include expected assets, liabilities and equity. Again, the budgeted statement of cash flow, which predict or which based on the expected cash inflow and cash outflow. Again, the statement of cash flow, which classify the whole cash inflow and cash outflow activities into operating, investing and financing. Together these statements, the expected income statement or budgeted income statement, budgeted balance sheet and budgeted statement of cash flow, the organization will have a holistic or a financial picture of organization for a based on the future plan. Now, what are the importance of budgeted financial statement? Budgeted financial statement help the companies to see whether the profit targets are achieved or the liquidity levels will remain adequate, the debt obligation can be satisfied, again strategic objectives are being supported. So which will help the management to determine some or to answer some key questions like whether the current plan will help us to achieve the expected profit plan or the expected liquidity level, our debt obligations can be satisfied, our financial ratios obligations or ratio target can be achieved. Again, if our profit plan will support the whole business strategic objectives. Now, we will move into next concept, that is revision of budgeting, revising the budget. We know that in a real business, budget is not a one-time process. Suppose if the top level or middle level management prepared a budget and submitted to top level management for a further review, maybe they will suggest, the top management will suggest some review in their operations plan and the overall budget if the budget is not into the expected level of top management. For example, once the middle level management submitted a proposal, but the profit may be lower than their desired, or cash balance may be inadequate, or the debt level may be excessive. These are some examples where the top management can raise some concerns and suggest or request the middle level management or lower level management to revise their operational plan. This process may continue several times before the final master budget is approved. This can happen several times before the final budget is approved. However, management must avoid unrealistic budgeting practices. Budgeting should be realistic as possible and it should not unrealistic. And the budget target should remain challenging and achievable as well. It should be a challenging target, at the same time it is achievable as well. Again, overly optimistic budget may lead to poor decision, employee frustrations and ineffective performance evaluation. If you fix a very optimistic budget, which will lead poor decision making, poor resources planning, employee frustrations and ineffective performance evaluations. So, to address this, the top level management normally, as a process, the top level management may suggest some revisions in the budgeting or in the operations plans before the budget got finalized. Now, loan covenant and budget planning. What is loan covenant? Loan covenant means some obligations with the bank if you take some loans from the financial institutions. These are some financial restrictions. That means you have to maintain your financial positions in a better healthy positions. So, loan covenant required the companies to maintain specific financial ratios or performance measures. These are some conditions where or a contract which included in the loan agreement with a financial institutions, where you have to maintain a minimum current ratio, a minimum maximum debt equity ratio, a minimum interest coverage ratio. These are some examples which you can include in the loan covenants. So, the budgeting, this loan covenant also to be considered in your budgeting process, and you have to make sure that in all stages of your financial positions, the loan covenant terms are fully satisfied. Again, if the management identify a potential covenant violations during the budgeting process, the corrective actions can be taken before the problem occurs. This is one of the key reasons where the budgeted financial statements are extremely valuable if your company have a loan covenant. Now, if you remember, we have discussed in the previous session, budgeting is an ongoing process. It is not a one-time process. Once the budget is approved by the management, it has to be implemented into action plan, and there should be a periodic proper review system to see the variances and the corrective action to address those variances. The management uses budget report to evaluate actual performance against the planned performance. This report compare your actual revenue with the budgeted revenue, again your actual expenses with the budgeted expenses, and actual output with the planned output. This comparison will help the management to see is there any deviations between the budgeted and actual, and address those deviations and make corrective actions in advance. Now let's move into variable analysis. Variance analysis. What is a variance analysis? This is a comparison between your actual result plus your budgeted results. There will be two kind of variances. The first one is favorable variances and the second one is unfavorable variances. Favorable variances mean it is a favorable to the company, which means the actual revenue exceeded budgeted revenue or actual cost is lower than budgeted cost. Both are favorable to the company. Then the unfavorable variances, unfavorable mean which is unfavorable to company's performance. That means actual revenue is lower than the budgeted revenue or actual cost exceed budgeted cost. These are the unfavorable situation to the company. Again, these variances indicate the operation problem or the execution problem with the company, so which require an investigation and has to be corrected, has to be reviewed and corrected for the future performance. Again, not every unfavorable variance signal to poor performance. Suppose the company initially planned to sell 10,000 pieces and the company sold 20,000 pieces. Naturally, you will have a higher material and labor cost. So we cannot consider all the unfavorable variances as signal of poor performance. So this required independent analysis to see whether these unfavorable variances are the result of poor performance or with the result of different activity levels. Now, investigating variances. Again, significant or unexpected variations should always be investigated. If the variance is significant or it is unexpected, that variances has to be investigated. Again, what is the objectives of variance analysis or variance investigation? Why this variance is occurred? Whether is there any corrective actions is required, or whether the budget itself should be revised to see which will determine, or the variance investigation will determine these things. Again, possible cause of variance include changes in the demand level or inefficient operations, unexpected economic conditions, pricing changes, production problem, changes in the input cost. These are the some possible causes for the normal variances. Again, variance analysis form part of the organization control system, often required as a control loop. Normally, variance analysis is a part of organization control system, again, which is a control loop which include establish the performance standard. Before the variance analysis, you should establish the performance standard and the measure actual performance. So once you establish a performance standard, you can compare your actual performance to measure to see is there any variances. The third one is compare the actual with the budgeted results. Once you measured your actual result, you can compare that the budgeted or expectation. Then investigate the significant variances. Is there any significant variances in the process? It has to be investigated. Then implement corrective actions, review and revise the standard. If the standard has to be reviewed and it has to be revised once it is required. So, before winding up this discussion, here are some important points to remember from this area. We started with the financial budget. Financial budget consists capital expenditure budget, cash budget, budgeted balance sheet and budgeted statement of cash flow. Then the cash budget usually prepare the last budget before budgeted financial statement. And what is cash budget? Which track the cash, expected cash receipt and cash disbursement for a period of time. Then cash budget is a planning tool where the budgeted cash flow statement is a projected financial statement. This is the key difference between the cash budget and cash flow statement. Again, we discussed about a cash inflow, that the collection from the customers usually the large source of cash inflow. Then the key cash outflows, which include the direct material, payroll, overhead, taxes, capital expenditure are the common form of cash outflow. Again, cash shortage has to be identified in advance, which will help the management to obtain financing more efficiently. If the company can understand the expected cash out shortage in advance, which will help the company to plan the cash shortage or cash financing more effectively or efficiently. So the excess cash should be invested whenever possible to improve the return. Is there any possibility to improve the return, the excess cash has to be invested or reinvested. Again, we discussed about the seasonal business. Seasonal business are particularly have a benefit from the cash budget, which help them to plan the on season and off season. Then the budgeted financial statement summarize the expected financial result of planned operations. What are the budgeted financial statement, which include the income statement, balance sheet, statement of cash flow, which summarize the overall result of planned operations. Again, budgeted income statement, balance sheet and statement cash flow are interconnected. We know that even if these statements, whether it is budgeted or the actual, which is interconnected. Again, the budget review and reversal. The management often revise the budget several times before the final approval to make sure that the budget is meeting the expected financial results. Again, the budget assumptions must be realistic and attainable. Budget always should be attainable and challenging as well. Again, the loan covenant. Loan covenant are the terms which included in the loan agreement with the financial institutions, which will have a big impact in the budgeting decisions. So, which may force the company to maintain certain financial ratios and financial health. Again, ongoing budget report compare the actual performance with the budgeted performance to see the variances and to address those variances. Again, the favorable and unfavorable variances. Favorable variances occur when revenue exceeded or costs are lower than planned. Unfavorable are just opposite of favorable variances, which mean revenue fall short of expectation or cost exceed planned demand. Again, the significant variances has always to be investigated and the corrective action has to be taken. Then variances analysis is an essential component of management tool, which include setting standards, measuring performance, analyzing variances, investigating causes and taking corrective actions. Also, which include the revising standard once it is required. So friends, this is about today's discussion. If you have any doubt or you need any clarification on any of these topics, please comment on the comment section. Thank you for watching this video.